What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to another episode of our tier list special, where we take a look at the top 10 largest stocks of famous investors and rank them in comparison to each other, but also a little bit to the broader market as well. And we do this on the basis of where these stocks are trading for at today's prices and how much I'm attracted to them myself based on my own personal opinion. So it doesn't mean that I'm right in all of these rankings. It's just my own personal opinion as someone who likes to invest in long-term growth and dividend stocks at reasonable valuations. And in this episode, we'll be taking a look at Bill Gates' portfolio, who is obviously famous for founding Microsoft. But if you want to check out past episodes like the ones I did on Warren Buffett's portfolio or even Jeremy's from Financial Education, you can find those past episodes in the tier list playlist, which you can find up here down in the description or at the end of this video on a clickable card. And as always, our ranking system will consist of 5 different tiers from S down to D, with S tier being the very best of the list, the A tier being solid above average stocks, B tier being mostly average, C tier being below average, and D tier being the weakest stocks of the bunch. And the rules are that there needs to be at least one stock in every single tier, and there can be no more than 4 stocks per tier so that we spread everything out more and end up with a clean and more evenly balanced ranking. Anyway, back to Bill Gates. He has an estimated net worth of close to $100 billion, and his investment trust that we'll be taking a look at today holds close to $20 billion worth of stocks as of the end of June, although ironically Microsoft is not one of the stocks in the fund. And I'll just tell you guys right now that Bill Gates' portfolio is much more kind of conservative, I guess is the right word to say. I would also say value oriented, but because the markets are trading at record highs right now, most of these stocks on the list are not a good value in my opinion. Like some of them you'll notice are pretty overvalued or overpriced when we take a look at their valuation. So just kind of keep that context in mind. I may be a little harsh on his portfolio just because of the time where we're doing this video when the market is trading so high. Okay, now I got these figures from gurufocus.com, and coming in at stock number 10 on the list, that's going to be Coca-Cola. Ticker symbol is KO, at just under 2% of his portfolio. And as I'm sure all of you know, Coca-Cola is famous for the Coca-Cola drink itself, but also for owning other very popular brands like Dasani Water, Fanta Soda, Fairlife Milk, Gold Peak Tea, Minute Maid and Simply Orange Juices, Powerade and Vitamin Water sports drinks, Sprite Soda, and more. I personally like PepsiCo more for their diversification through solid snack foods and their extremely popular and high growth sparkling water brand called Bubbly, but to be fair to Coke, they're actually launching a new sparkling water brand themselves that is also caffeinated called AHA, that is set to launch next year, and in my opinion will be a much bigger deal than people realize, given that sparkling water sales are actually soaring at a time when sugar sodas are in decline. In any case, the stock hasn't really moved much in recent history, only climbing by 23% over the past 5 years, which is likely due to horrendous performance in their business, as sales have crashed over the last 4 years and are only now expected to recover, but even by 2020, they will still be lower than what they saw all the way back in 2015, which is obviously not a great sign. To be fair though, Coca-Cola is just one of those slow-moving stocks that is mostly invested in for its amazing dividend that still yields over 3% despite having grown for 57 straight years. That is massive, a massive amount of time to be growing. The payout ratio is pretty high though, leaving the dividend with very little growth potential, and despite the weak sales performance, the stock still trades for a premium to the sector on both a PE and PEG ratio basis. I know a lot of my viewers like this stock, but I just can't help but think that Coca-Cola is a bit of a mediocre stock overall, but because of the strong branding and giant size of the company that will likely keep them competitive in the future, I'll show Coca-Cola some mercy and I'll put them in the B tier for now. Although I may change my mind later as we go through the list. All right, moving on to stock number 9, that's going to be United Parcel Service, otherwise known as UPS, ticker symbol UPS, at about 2.36% of his portfolio. And this is the world's largest package delivery company that should continue to see growth in the future given how interconnected businesses around the world are becoming, and also thanks to online shopping that still only made up less than 12% of total retail last year. However, there's concern growing amongst investors from the fact that Amazon has been expanding their own delivery services for years now and have even become their own primary shipper, outpacing even the US Postal Service for the first time in history this year. That's a big deal for UPS given that Amazon accounts for close to half of US e-commerce sales and around 5 to 8% of UPS's total revenue. Still, because UPS has such a large domestic and international business that obviously doesn't just rely on e-commerce, they've been able to continue growing their sales every year for the past 4 years in a row and are expected to continue doing so into the future as well. Keep in mind that this is at a time when the global economy is incredibly weak and the two largest economies in the world in the US and China are currently still going through a trade war, although we are supposedly making progress, but we're still technically kind of having this dispute. So for UPS to be posting growth is actually very impressive. Still, the stock has been incredibly volatile over the past 5 years and is only up by less than 15% over that time. On the bright side, this leaves them with a forward PE ratio that is almost 25% cheaper than the sector and a very nice dividend that yields over 3% and also has a better payout ratio and 5-year growth rate than CocaCola, with still nearly 2 decades of consecutive growth to go right along with it. So because of the more consistent sales growth, the cheaper valuation, and a similarly attractive dividend, I'm actually going to put UPS in the A tier for now above Coca-Cola, even though I may move them down later if I see better looking stocks. Okay, moving on to stock number 8, it is extremely fitting that we would have this stock up next, and that's going to be the UPS rival in FedEx, ticker symbol FDX, at about 2.5% of his portfolio. And this company is very similar to UPS, so I won't talk too much about it, but I will just quickly note that they've been struggling a bit more than UPS and have mostly blamed the macroeconomy as well as the trade war for their misfortunes, and most recently they even announced that they will no longer provide ground or air shipping for Amazon in the United States, although they do still have an international contract in place. Either way though, Amazon only accounted for a little over 1% of FedEx's total revenue last year, so the company feels that this was the right decision so that they can focus more on providing delivery services to other companies that are not also direct competitors. In any case, FedEx has actually been growing their sales by pretty nice rates every year, but this year it's only expected to climb by 1%, while the real problem lies in their profitability that happens to be crumbling. Net income has now dropped from over $4.5 billion in fiscal 2018 all the way down to just $500 million this past year, and even less than that over the last 12 months, while their EPS is expected to continue dropping by over 21% this year as well. For comparison, UPS did almost $5 billion of net income over the past 12 months, and their EPS is expected to continue growing both this year and over the next 5 years as well, so a much more stable business overall in my opinion. Still, a lot of this is being priced into the stock as FedEx is currently down over the past 5 years after crashing heavily since the start of 2018, leaving them with a P/E ratio that is over 40% cheaper than the sector median. And to top it off, they have a very attractive dividend that only yields 1.6%, but has a very low payout ratio of 21%, a very high growth rate of 33%, and 17 straight years of growth. As far as how to rank them, this is honestly a tough one to call, but I think I'm going to put them right in front of Coca-Cola given that they have a much more attractive valuation, but behind UPS for reasons that I stated earlier. Okay, coming in at stock number 7, that's going to be Crown Castle, ticker symbol is CCI, at over 3.5% of his portfolio. And this is actually a very interesting REIT, real estate investment trust, that manages and provides cell towers and locations for internet connectivity, which is obviously a huge market for the future when you think about the rise of smartphones, autonomous vehicles, the Internet of Things, artificial intelligence, 4G and soon 5G, and of course just the overall internet market itself. Now, Crown Castle claims to have the largest shared communications infrastructure in the country, with over 40,000 cell towers and more than 75,000 miles of fiber, giving them a presence in every major US market. This means that the company is likely built for decent growth in the present and in the future. And that's mostly what we see in their performance, as their sales have climbed by very healthy rates over the years, with 23% growth last year, although that's slowing down this year and the next, but their profits are still growing at very high rates, with EPS growth expected to be north of 20% a year over the next 5 years. And because they're an REIT, they're required to pay out over 90% of their taxable income in the form of dividends, which leaves them yielding close to 3.7% at this time. Unfortunately though, this is all being priced into the stock already, as they are currently up by 64% over the past 5 years and trade for a sky-high valuation of a 55 forward PE ratio. Now, for some reason, Seeking Alpha doesn't give a sector median for this one, but they do provide a 5-year average, and when looking at that figure, Crown Castle actually trades for about 30% cheaper than it has in the past. Still, those forward PE and PEG ratios seem extremely high to me regardless. Admittedly, I know very little about rates, so maybe it's normal that they trade very high, but in my opinion, there's cheaper stocks out there with similar performances and dividends, so I'll keep this one in the B tier for now, but I'll put them ahead of Coca-Cola as they seem to perform better over the long term. At least that's what we've been seeing in kind of the recent history. Okay, moving on here to stock number 6, that's going to be Ecolab, ticker symbol is ECL, at over 4% of his portfolio. And this is a company that I'm not very familiar with myself, but apparently they're a market leader in selling sanitation and cleaning products and services in over 170 countries around the world in a huge variety of markets and industries. I'm showing you a few screenshots here, but there's like another 15 pages of this to go through, and I just don't have enough time to show you them all. But needless to say, this is looking like a pretty widely diversified company within their specialty, and it also seems like the type of business that will probably always be needed. In any case, sales have been decent in recent history with 7% revenue growth last year, but that's expected to drop a bit this year and the next, probably because of the weakening global economy. Still, Ecolab has been able to grow their dividend every year for the past 26 straight years, and while the yield is very low at today's prices at less than 1%, it's also been growing at close to 12% with a low payout ratio to go right along with it. So far, the stock has climbed by almost 70% over the past 5 years, but that strong performance has left them with a very rich valuation as they trade nearly 50% more expensive than the sector on a forward PE basis. And at the end of the day, I'm just not seeing enough future growth to justify the sky-high valuation. And for those reasons, I'm going to put them down into the C tier. Okay, moving on here to stock number 5. That's going to be the very popular retail chain that you've probably shopped at yourselves, I'm sure. And that's going to be Walmart. Ticker symbol is WMT at about 6.5% of his portfolio. The stock really tanked hard in 2014 and 2015, but then rallied very strong in the years to follow, leaving them up by over 50% in the past 5 years. Now, sales for Walmart are gigantic as they bring in over $500 billion a year, and while the growth is very low, it's at least been positive and usually grows by over $10 billion at a time, so that's pretty significant still. They do also pay a very reliable dividend that yields somewhat close to 2%, has a reasonable payout ratio, and has grown for 46 straight years. So even though it's a low growth dividend, it's also one that is very unlikely to get cut anytime soon. And as much as investors try to write off Walmart because of the rise of Amazon, it's important to note that Walmart has done a great job of competing with their own e-commerce platform, as they're projecting to grow their online sales by a massive 35% this fiscal year alone. Still, Amazon recently removed its $15 monthly fee for grocery deliveries for Prime members, whereas I believe Walmart still charges about $100 a year for a similar service, and grocery delivery was actually one of the key strategies for Walmart to grow their online sales. So this may spell some trouble for them in the future. Of course, for Prime, you still have to spend around $120 a year, but it's practically a given now that most households have at least one Prime account regardless. Either way, as much as I like Walmart, the valuation is a bit higher than the sector, especially on a PEG basis, and it just doesn't look very attractive to me from a growth perspective either. So I'm going to put them right behind Coca-Cola for now, since I think they both have very popular branding, but Coca-Cola has the more attractive dividend, at least in my opinion. Okay, here, moving on to stock number 4, we finally have a stock that I'm actually interested in myself, and that's going to be Caterpillar. Ticker symbol is CAT, at about 7.7% of his portfolio. And the reason I like Caterpillar is because they're already the largest construction equipment manufacturer in the entire world, with an extremely strong brand that is pretty much recognized anywhere, and they also pay a very nice dividend that yields close to 3%, despite the fact that it's grown for the past 26 straight years with a 5-year growth rate of almost 14%, and still has a moderately low payout ratio to sustain even more growth in the future. Unfortunately though, Caterpillar is heavily exposed to the macroeconomy, and as a result, their performance can be very volatile and cyclical, as their sales actually dropped by 18% in 2016, bounced back by 18% in 2017, soared by 20% last year, but are now expected to drop again by 2% this year and 3% the year after, mostly due to the weakening global economy as well as the trade war with China. And what's even more unfortunate for me is that I've been hoping to buy the stock into this weakness. I was hoping that these weak results would give me a great buying opportunity, but the reality of the situation is that the stock is actually up close to 50% over the past 5 years and is still sitting at the very top of their 52-week range. Still, their valuation remains attractive even at these higher levels, as their PE ratio is actually 32% cheaper than the sector. I'm still not ready to pick this one up because I think the price needs to come down more to reflect the macroeconomic weakness that is hurting their growth, but as soon as it does, I'm planning to buy into this weakness pretty heavily myself, and for those reasons, I'm just gonna go ahead and toss Caterpillar up on the S tier, because so far I just haven't really been impressed with any of Bill Gates' stocks, and I'm starting to doubt that I'll see anything better on the list, but time will tell. Okay guys, moving on to stock number 3, so we're down to the top 3 now. And coming in at number 3, that's going to be Canadian National Railway. Ticker symbol is CNI, at just barely less than 8% of his portfolio. And this is one of the biggest railroad companies out there. In fact, they're the only transcontinental railway in North America, with a nearly 20,000-mile network connecting Canada, the US, and Mexico, and reaching all 3 coasts, those being the Pacific, the Atlantic, and the Gulf of Mexico. And they offer a number of services throughout their infrastructure, including logistics, freight, transportation, rail, marine, and even trucking, to offer a complete supply chain solution to their customers. As a result, they've been able to bring in billions of dollars in revenue every year, and with the exception of 2016, have also been growing at some pretty healthy rates as well, especially for an old rail company. And the strong sales are also leading to higher profits, as their EPS is expected to grow by close to a double-digit rate both this year and the next. Still, the stock is a bit of a slow mover, only increasing by 36% over the past 5 years, and it's also been a bit volatile over that time as well, although they currently sit near all-time highs. That's also led to a mixed valuation, as they trade slightly cheaper than the sector on a PE basis, but are considerably more expensive when looking at their PEG ratio. They do, however, pay a very nice dividend that only yields less than 2% at this time, but has grown for a decade straight, has a double-digit growth rate, and a pretty low payout ratio to go right along with it. So while I don't consider them to be a very exciting company, they do seem pretty stable for the most part, and for that reason, I'm going to put them in the B tier. Now, we have a problem here though, because we already maxed out with 4 stocks in the B tier, so by default, I'm gonna have to drop Walmart down to the C tier, even though I really don't want to, but I'm gonna go ahead and put Canadian Railway just barely behind Coca-Cola, but ahead of Walmart because of the higher growth, the cheaper valuation, and the similarly attractive dividend. Alright guys, moving on to stock number 2, that's going to be Waste Management. Ticker symbol is WM, and this is the first stock on the list to make up over 10% of his portfolio. Now, I'm sure you guys have heard of this one. They're likely the guys that handle all of your garbage, which by the way is a service that we will always need. And because Waste Management is the market leader in North America that continues to acquire smaller competitors whenever they become a real threat, this is a company that is not likely to disappear anytime soon. As a result, the stock has performed very well over the past 5 years, climbing by almost 125%. Unfortunately, that strong performance has left them with a rich valuation, as their P ratio is almost 20% higher than the sector, but I think most waste management bulls would argue that you get what you pay for, as this is a very reliable business that continues to grow sales by healthy amounts every year, pays out a dividend of almost 2% that has grown every year for the past 16 years, and again is a business that is not likely to go under or even face any real competitive threats anytime soon. Still, because of the high valuation, I wanted to put Waste Management in the B tier, but because we're already maxed out there and because I think that they're more stable than the rest of the stocks in that tier, I'll just go ahead and move them up to the A tier by default, but I'll put them right behind UPS. Okay, and finally, that leaves us with the largest stock in Bill Gates' entire portfolio, and that's going to be Berkshire Hathaway B shares, so ticker symbol BRK.B, at an absolutely massive 50% of his portfolio. And as you might know, Bill Gates is close friends with Warren Buffett, who happens to be the CEO of Berkshire Hathaway, which is a giant holding company that either owns or invests in a number of different companies. Those including big names like Geico, Fruit of the Loom, Southwest and Delta Airlines, most of the major US banks, and even CocaCola and Apple. Now, their performance can be pretty volatile as it depends heavily on how the overall markets are performing, but because Warren Buffett and the rest of the management team are so highly skilled, they tend to perform pretty well over the long term. As you can see here, sales sometimes rise by pretty high amounts, but can sometimes plummet as well. Still, the stock usually performs well again over the long term and thus has climbed by over 50% in the past 5 years. Unfortunately for dividend investors, Berkshire Hathaway does not pay any dividends, as Warren Buffett believes more in reinvesting the profits, which is kind of ironic because he's definitely known for collecting gigantic dividends himself, but maybe that's a topic for another day. In any case, their valuation is pretty rich at this time, with a forward P ratio that is 62% higher than the sector. And so because they have a volatile business, do not pay a dividend, and have a very rich valuation, I'm just going to go ahead and put Berkshire Hathaway down in the C tier right behind Walmart. And because we have to fill all the slots, we'll go ahead and drop Ecolab down to the D tier while we're at it. Okay, so there you have it, guys. In the S tier, we have Caterpillar. In the A tier, we have UPS and Waste Management. In the B tier, we have FedEx, Crown Castle, CocaCola, and Canadian Railway. In the C tier, we have Walmart and Berkshire Hathaway. And then finally, in the D tier, we have Ecolab. So what do you guys think about my ranking? Would you make any changes, or do you agree with my overall kind of ranking for these stocks? Now, if I had to guess which stock you guys would probably disagree with, it's probably going to be Walmart, because after recording this video, I'm starting to think now that I probably should have ranked Walmart higher, because they actually do have a pretty impressive business that is extremely large and is still growing. And it's actually pretty hard to grow when you're already so massively large and you also have a competitive threat like Amazon, yet Walmart is still kind of growing. So I think maybe I would give Walmart a little bit more of a I guess maybe some leeway, or like the benefit of the doubt. I would be a little more forgiving to Walmart if I redid the video and maybe bumped them up, but I'm just not really sure which stock I would move down to replace them with. So I don't know. Maybe you guys can let me know down in the comment section. Anyway, I hope you guys enjoyed the video. If you did, make sure you hit the like button. And if you have any suggestions for future videos, and especially if you want me to take a look at other investors' portfolios and do this with theirs, let me know down in the comment section as well. Thanks again for all the support, guys. It really means a lot to me. I'll catch you guys in the next one. Take care. Bye-bye.